so the next part of our agenda, we want to focus a little more broadly on the Minnesota economy. And we're really pleased to have with us Joe Mann from the Minneapolis Federal Reserve Bank. They do a lot to track what's happening, especially in the construction field. And I think he's not only going to give us some information, but I think he's hoping that you all will give him some information too. So I'm going to turn it over to him. I'm going to make him, oh, he's there. Okay.
Yeah, I just tried sharing my screen with you. Let's see if you can tell me if you can see my slides. Can you see my slides? Great.
Yes, we can. So I'm going to turn it over to you and let you take it away.
All right. Thank you, Margaret, and thanks everyone for being in attendance virtually today. Sorry I couldn't be there with you in person. We couldn't all do this together, but maybe in the future. So yeah, I'll be talking about the state of Minnesota's economy, a little bit forward looking, a little bit backward looking, and I'm really going to focus on a couple things. The particular challenges that the COVID-19 pandemic has posed for us, for economists and folks at the Federal Reserve in trying to get a grip on what's happening currently in the economy and where it's going. And I'll talk about kind of some of the data that we've turned to in place of that, the data that we usually look at. And then I'm hoping to do some interactive surveying with you. And then that way you can kind of see what each other are thinking and share some info with me. And I think that'll hopefully be interesting for you. Quick disclaimer, my views are my own. The Federal Reserve is a sort of nonpartisan independent institution within the government. So that doesn't mean that those of us who work for the Fed don't have our own views. I just want to make it clear that if I say anything stupid, it's my fault and not the Fed's. As I mentioned, I'll be talking about the kind of data challenges that are presented by the pandemic and what we've done to address this need for better real-time info. In particular, I'm going to focus on some of our surveys that we've been rolling out and ongoing surveys that we do. I'll talk in particular detail about a survey that we're just releasing this week on the construction sector. I'm going to go through some of this material kind of quick, and I'll put a quick plug in if you're interested in more detail on anything I say. This material is going to be available on our website, minneapolisfed.org. And my colleague Ron Wirtz and I are going to be hosting a webinar tomorrow morning where he's going to be talking a little bit more about some of these construction results that I'll be going through a little bit more quickly. I'm also going to highlight some results of a survey that we did on the professional services sector. Might not seem as germane to the transportation industry as the construction sector. Obviously, construction, one of your intimately related with transportation services, maybe not as much, but I think that's a better barometer. I don't say better barometer, but it's another barometer of the overall economy and where things are going. And I think, will give you an opportunity to see that this is affecting a broader swath of the economy as well. And then, as I mentioned, I'll talk a little bit about what we're seeing in terms of some of our other measures of consumer sentiment and kind of higher frequency economic data. And I'm going to hope to do interactive survey with you, and I'm putting the steps up here. I'm going to ask you if you're willing to share information with me and with the others in the audience and participate in our survey via your smartphone. So what I want you to do, if you would be so willing, is to get logged into our survey app. You don't need to install any software on your phone or anything like that. I just need you to send a text to the number 22333. And I want you to send the word Minneapolis. And then after you hit send, you should get a confirmation message. And then you can just keep responding to that when I prompt you for some survey questions. So send a text to 22333, text the word Minneapolis, and keep an eye on that. I won't get to some survey questions until a little bit later. So let me talk a little bit about some of the traditional economic indicators that we look at. One of the best indicators that we have of kind of overall economic activity, of course, is gross domestic product. That's kind of a measure of the value of goods and services produced nationally. And then we also have state level estimates for GDP. Not surprisingly, a big drop in GDP in the second quarter of this year as we all went into lockdown around the U.S. and in the district as well. I'm showing you also Minnesota and Wisconsin. And I want to point out that we don't actually have an estimate of third quarter GDP for Minnesota and Wisconsin, because these data, and particularly at a local and state level, they come out with a big lag. So we know that the U.S. GDP rebounded quite a bit in Q3. It's a little bit of illusory. One of the things that sort of grabbed headlines is it was actually the fastest GDP growth that we've ever had in terms of percentage terms, but that was because it fell so much in the second quarter. And so I don't want to make, I don't want to play down the recovery that we've seen. But we're still below where we were going into the pandemic, as you can see in this chart here. And I would expect to see something similar for the states in the region. By the way, I should have said this at the outset. So the Minneapolis Fed is one of the 12 reserve banks, Federal Reserve banks that cover the United States and our region. So I'm going to keep it focused mostly on Minnesota. But our region also covers the Dakotas and Montana, as well as portions of Wisconsin and the Upper Peninsula of Michigan. So that's a 9th Federal Reserve District, and that's what we tend to think of as our region. But again, I know your Minnesota audience, and I'm going to keep it mostly focused on Minnesota. So I just showed you GDP. That's kind of a measure of economic production and output. The other thing you can look at, of course, is the labor market. And I'm going to be talking a lot about the labor market later in some of my slides here. But I just kind of want to point out, again, we've seen some recovery in employment, but still well below where we were heading into the beginning of this year. And you can see that again in the employment index that I have here for Minnesota, Wisconsin, the United States. And then I've broken it out for some of the data that we have on our cities in Minnesota as well. And I want to point out that that we've seen some recovery, some rebound in total job number of people working, but it appears to be maybe leveling off or flattening a bit. And as I mentioned, I'll be talking in a little bit more detail about construction. So I just broke this out here as well for the construction sector. It's important to point out that unlike the rest of the economy overall, construction employment was actually starting to fall even before the pandemic. So you can look into the beginning months of this year in Minnesota. We started to see some decline in overall construction employment in the late months of last year. Just a quick measure of construction starts here. This is a sort of moving average through September of this year. We've seen some decline in the value of construction, but it hasn't been a precipitous fall like we've seen in some of our other economic indicators. So, but we don't know exactly when we're gonna where the sort of bottom is in terms of the decline that we're seeing in construction. So as I mentioned, the traditional economic data that we look at come out with a lag early on in the pandemic when we knew that there were severe economic impacts. The data hadn't caught up yet. And so we turned to some other sources to try and gauge what was going on. And we've continued to rely on those as things have continued developing rapidly. And one of the best tools that we have at our disposal is our surveys. We do an annual survey of professional services. I'm going to move through this fairly quickly because I think that maybe it's not going to be as interesting to you as the construction material. So the services sector is a kind of broad swath of the economy that includes people in doing things as disparate as scientific research, design, engineering, also accounting, business consulting, a whole broad swath of the economy. We're talking about a sixth of the total employment in the state is employed in services. And a lot of people who work in the services sector, though not all of them, work in a sort of an office setting or some other kind of setting where you might think that they would have an easier time adjusting to a work from home type of environment. And so it was noteworthy that we still saw, in spite of the fact that maybe this sector wasn't affected as tangibly as some of the other sectors that are more face to face, we still saw a pretty severe impact on the services industry. And again, that's probably a reflection of kind of broader economic issues going on. So just to kind of walk through some of these quickly, we asked these businesses about an array of indicators and what they saw over the last year. So we asked them about profits, productivity, employment. This is a diffusion index. So real quickly, anything to the right of that solid black line of value of 50 indicates that on average, these businesses told us that that indicator fell over the last year, and anything to the right indicates that on average, they told us it increased. So for an array of indicators, sales revenue, employment, um, profits and productivity, they told us that that their growth had fallen over the last year. And this is noteworthy because we did this survey in the middle of the year. We asked about a 12-month window. So this included the growth that most of these firms experienced through the end of the second half of 2019 and the first couple months of 2020. And those firms did tell us that in fact they were growing over that period on average. Of course, it varies a lot from firm to firm. So it's noteworthy that the contraction that we saw up through the middle of the year was enough to kind of wipe out some of those gains. And just to kind of underscore this, here's the indicators for sales or demand and employment over going back to 2006. We missed a year in 2011. We didn't release a survey that year, and I just want to point out that this contraction is coming after a period of a multi-year period of relatively strong growth for these firms. We also asked them about their outlook for the coming year for the same indicators. Again, this is that diffusion index. So anything below 50 is decreasing. And they told us that their expectations for the coming year are for this slowdown, this reduction in activity to continue through mid 2021. Again, these are services firms, and so this is their outlook. And we did this survey in the middle of the year, so this is their outlook through mid 2021. And I just need to point out again, if you compare to where their outlooks tend to be in the previous years that we've conducted this survey, they're about the most pessimistic that these firms have ever been on average in terms of their outlook for demand, for sales, and for employment. And that includes 2009, the Great Recession. So overall, fairly pessimistic outlook from those firms. Their outlooks for the overall economy is not surprisingly not great either. So this is their outlooks for employment and a number of other macroeconomic indicators at their state level. They're expecting the overall economy to contract and for employment to fall as well. So I just kind of wanted to go through that really quickly. Again, happy to answer questions. And again, I should have said this at the outset. If you do get questions, I'll try and leave plenty of time at the end for questions. But if you do get questions, Margaret, during during my talk, please feel free to interrupt, and I'm happy to answer questions rather than just methodically walk through a bunch of slides over the course of this talk. So now I'm going to walk through some of these construction sector results. Again, maybe more germane to the transportation industry because these are going to be a lot of clients. They're purchasing materials that need to be delivered to them. And some of them might be working on infrastructure projects as well. So we did this survey in partnership with a number of trade associations, construction trades associations throughout our region. We got about 400 responses, close to 400 responses. About half of them were from the greater Minneapolis-St. Paul metro, and about half from the remainder of that multi-state region that I described earlier, including the Dakotas, Montana. And we broke them down into whether they were residential, commercial, industrial, or infrastructure. And again, just as I just described, ask them about conditions right now and what they see going forward. Very mixed picture in terms of revenue that these firms were showing us. So I'm going to show you a lot of charts that look like this. So just to kind of describe what I'm showing you here, this is a breakdown of responses from the survey takers when we asked them at their firms whether revenue had fallen or increased. And the red indicates that they saw lower revenues. Green indicates that they saw higher revenues. And we broke that down between a little bit higher and significantly higher, a little bit lower, significantly lower. And we also gave them the opportunity to say that there hadn't been a change. And we did several periods of comparison. So we asked them to compare the previous 3 months through October with the 3-month period prior to that, not exactly calendar quarters, but May, June, July versus August, September, October. And then we also asked them to compare that same period last year. Fairly mixed bag in those first two comparisons. Firms, there are about an equal number of firms telling us that they saw increased revenues as those telling us that they saw decreased revenues. But the outlook for the remaining 2 months of this year and into January, we had a larger proportion of firms telling us that they expected lower revenues. So that's going to be consistent with some of the other things that I'm going to show you here. Just to break that same kind of comparison down by sector, this is the last 3 months compared with the 3-month period before. We saw worse results among commercial builders and construction firms than we did compared to residential builders. As a lot of you know, a lot of people, while they're sitting around at home, are deciding to invest in their houses. The housing market is still very strong, and residential building has held up pretty well during this period. We had a higher proportion of firms in the non-residential commercial telling us that they saw a decrease in their revenues. Growing number of firms also telling us that they're seeing increased cancellations of projects or delays. Still a large chunk saying that there's not much change, but you can see a much higher proportion of respondents telling us that they've seen increased cancellations compared to those saying that they've seen decreased cancellations. And this is similar to what we found in the previous survey that we conducted in July. Another kind of forward-looking indicator, RFPs, projects out for bid. You can see we've seen a reduction it looks like a reduction in the pipeline of future projects. So what's interesting about this, going back to, as I mentioned, that early part of the contraction post-pandemic, the construction sector actually held up pretty well during those first few months compared to a lot of the other sectors. And we're starting to see some more signs of a slowdown now. And that's consistent with what we're seeing in these surveys and also in some of the data as well. As I mentioned, the residential sector is a relative bright spot compared to non-residential and industrial. Smaller proportion of firms telling us that they've seen a decrease in RFPs and more of them telling us that they've seen some increase in RFPs over this period. So now I'm going to ask you, I'm going to get back to a little bit more of these survey results in a moment, but if you could pick your phones back up, those of you that logged in and sent a text to take a survey, I want to ask you, hopefully you can see this on your screen okay. I want you to text the letter that's consistent with the experience that you've seen so far. So I want you to think about demand for freight in the previous 2 months, September, October, at your firm, and I want you to compare it to the 2 months prior to that. So looking back on the last 2 months, how did it grow compared to the previous period? And you can see we're starting to see some results roll in right now. If you saw a big increase in the last 2 months compared to the previous 2 months, that'd be A. Some increase would be B. If it was flat, it looks like most of you are saying flat, and that's going to be C. Down some would be D. Down significantly would be E. And if you don't know, tell me F. And I'm going to let these roll in for a little bit here. Probably not surprising that a lot of you are seeing kind of steady activity. Some of the indicators that I'm actually that we have on our COVID dashboard on our website, minneapolisfed.org. We track some transportation indicators, traffic indicators that we get from the Minnesota Department of Transportation. They've been great at sharing those. And heavy truck traffic actually, after falling a bit during the early stage of the pandemic, has held up pretty well during this period. So a lot of you saying you don't know, which is I'm wondering if those are folks from outside the transportation sector that are in the audience, legislators or others. But it looks like we've got a higher balance of people telling us that they're seeing an increase than a decrease, and nobody's saying down significantly. So that's pretty good news for the last 2 months. And now I'm going to move on to the next slide. Apologies if you haven't been able to respond yet. There'll be plenty of more opportunities to chime in. I want you to think about the overall rates for freight, again, whether you are a user or whether you are a provider. And I want you to, if you do me a favor and think about those excluding fuel surcharges. We know that obviously the price of fuel is pretty important in that. So I'm kind of curious about the more demand related factors here. If you've seen a decrease in freight charges, prices, that would be A. If you've seen no change, that would be B. And I want you to compare to the beginning of the pandemic. Some increase, but more slowly than usual, that would be C. Increasing at a normal rate would be D. If you are seeing the cost for shipping increase faster than normal rate, that would be E. And it looks like a lot of you are saying you don't know. Some of you jumping in saying they're flat, and then otherwise a pretty even mix. Nobody's saying that rates have fallen, which is kind of maybe not surprising. We all know that prices tend to either stay flat or go up, and they often don't drop. So I'm going to let those chime in or let those fill in. But it looks like for those of you that feel like you have some information on this, the majority of you are saying steady rates since the beginning of the pandemic. Good. Well, I think I'm going to cut this off in just a moment. Thank you all for chiming in, and going to move back to the construction survey and go through some of these other indicators that we had. So what I was showing you a moment ago were more kind of demand indicators, the number of projects out for bid. Now I'm going to turn it over to the kind of workforce picture. What's interesting, given that we've seen some reduction in demand, is that the majority of these firms that we surveyed told us that or I shouldn't say the majority, because the majority actually said that they're not hiring. But a larger proportion told us that they were hiring in one way or another than told us that they were reducing staff over the past 3 months. And the outlook for the coming 6 months that we asked them about is a little bit mixed, but higher on balance among those planning to hire, either to increase the total headcount or to just replace attrition and turnover. But they expect that gap to kind of narrow over the next few months. So stronger hiring picture looking backwards than we expect going forward. And there is, although it's still a minority, a higher proportion of firms telling us that they're expecting to cut workforce, again, whether it's for seasonal purposes or non-seasonal. Not surprisingly, given what we know about the sector as a kind of an ongoing thing, construction firms still reporting pretty tight labor availability. This is obviously a lot of the jobs that are out there are seasonal, or rather are skilled trades, and those aren't just those can't just be plucked off the street. Those, we were talking about people who need training, and this has been an ongoing condition. So it's interesting, but maybe not surprising that this hasn't changed that much, even given the contraction in overall activity. Wage growth, it's kind of interesting to point out that in a lot of other sectors, we've seen the pandemic-related contraction translate into declining wage pressure. In fact, a lot of firms reporting that they're cutting wages. That's not as much the case for these construction firms that we're surveying. A decent share of them telling us that they're not changing wages, or they're only changing them a little, but we're seeing greater upward wage pressure. Again, maybe consistent with that tight labor market picture I just showed you, and faster wage growth for skilled trades than for other jobs, excluding skilled trades. The inflation picture for non-labor inputs, so these are going to be your construction materials, and maybe they're also thinking transportation costs here as well, is moderate, but there are a decent share of firms telling us that they're seeing faster price growth, 5 to 10% or higher. Expectations over the coming 6 months, generally a little bit stronger, but kind of fewer at the extremes. Fewer people saying that prices are flat or down, and fewer people saying they're expecting price increases by more than 10%. One of the other things that we ask about, given kind of the current sort of extreme conditions that we're seeing, is how long firms expect to be able to stay in business if things don't change. And actually, this picture looks pretty good for most of these construction firms. The vast majority of them, close to 70%, told us that they expect that they could stay solvent for longer than 6 months. Only 3% said that they couldn't last more than 3 months under these conditions, so 3 months or less. So that's actually pretty good, again, compared to some of the broader business condition surveys that we're doing as well. I was just kind of going through some labor market indicators. So the Federal Reserve pays a lot of attention to labor markets because we have a dual mandate. We make monetary policy with an eye toward price stability, so low inflation, and full employment, so low unemployment. So we refer to this as the dual mandate. So we pay a lot of attention to employment. Not surprisingly, we saw a big increase in unemployment during the early stage of the pandemic, but it's come down fairly quickly by historical standards. It's still above where it was prior to the pandemic, both in Minnesota and the United States. But there's some reason to believe that the most recent reduction from August to September that we saw in Minnesota has more to do with what I'm calling falling labor force participation here. So you're only counted as unemployed. These statistics, by the way, come from the Bureau of Labor Statistics, part of the Department of Labor. And they get the unemployment number by surveying people at random and asking them if they're working. If you say you're working, obviously you're counted as unemployed. If you tell them you're not working, they ask you if you've been looking for work. So if you're not working but looking for work, then you're counted as unemployed. If you're not looking for work, then you're not in the labor force. So that proportion of people who are either working or looking for work, we call that the labor force participation rate. The unemployment rate can come down just because more people stop looking for work. And there's some indication that could be the case that we're seeing in Minnesota. Minnesota, by the way, has one of the highest labor force participation rates in the country, so I don't want to be too alarmist about this. But hopefully, that's a temporary thing rather than a permanent change, because we like to keep the labor force participation rate up. This probably has a lot to do with people deciding that they want to stay at home and avoid the risk of infection. So that probably has something to do with it. But we're learning more about this as new data become available. One of the other indicators that we look at that's a little higher frequency. So I just showed you again the problem with unemployment. Like the other indicators, it comes out with a lag, particularly at the state level. We just got September unemployment for Minnesota in late October. We get higher frequency information on unemployment insurance claims. So obviously, if people lose their jobs and they apply for unemployment insurance, that's an indicator of job market conditions. We saw a big increase in the beginning of the pandemic, and that's started to taper off, or at least the initial claims, that is people filing for the first time. So people who you'd think of as having just lost a job. That's tapered off, although it still is well above where it was prior to the pandemic. Continuing claims is more of a kind of ongoing indicator of the labor market picture. And we saw a higher peak in continuing claims during the pandemic than we saw ever during the Great Recession. Just to break this out for the construction sector, you're seeing a similar trend in unemployment insurance claims, and that's in spite of what we're being told are tighter labor market conditions in that sector. So that's kind of another kind of interesting maybe divergence between what we're hearing from the firms and what we're seeing from workers in terms of greater number of workers maybe starting to sit on the sidelines and having trouble finding work. I'm going to turn it back over to you now with a survey question, and I want you to tell me about what you're expecting at your own firms, for those of you who are in the industry, for staffing levels for the remainder of the year. Are you planning on hiring through the end of 2020? That would be A. If you're not planning on changing anything, that's going to be B. If you're going to cut staff, that's going to be C. And if you don't know or it doesn't apply to you, go ahead and send a D. Interesting that it's kind of an even race between hiring and no change. Oh, now unchanged is taking the lead. Pretty strong margin. Nobody planning on cutting staffing, which is maybe an indication of the relative health of the sector. Interesting to see these results. I'm wondering if anybody's going to chime in and say they're planning on cutting staff. Not necessarily. Okay. All right. Well, this is a pretty good sign. Looks like the majority of you are planning on either. Now that doesn't, if you're keeping things stable, but your firm cut a lot of employees earlier this year, that's not necessarily great. Oh, there's somebody who chimed in and said that that their firm's cutting staff. But it looks like the majority slight majority planning on keeping things unchanged, keeping stable staff, and a decent chunk of you actually planning to hire headcount. And again, we know there's been a kind of a long-term tightness in the supply of CDL drivers, and so it's possible. It's interesting to hear whether or not conditions are tighter in the transportation sector than in other sectors. So now I'm gonna turn it over. I'm gonna kind of mix up these polling slides with some other data that I'm going to share with you, and I'm going to talk a little bit about some of our forward-looking indicators, what we're seeing in terms of the virus impact on the economy, and I'm going to challenge a narrative a bit that is I think fairly present out there, which is this narrative that the impact of the pandemic on the economy has been largely due to policy, to states closing down. And so I'm going to kind of present some of the indicators that we've been tracking on our website. Again, there's a lot more of these if you're interested in following them on our website, minneapolisfed.org. Not surprising, this isn't really news to those of you who've lived through the last few months, but we saw a really severe contraction in April as the economy kind of went into lockdown mode. Some recovery, actually fairly strong recovery over the course of the summer. A lot of things having to do with that reopening of state economies, but also to several phases of the CARES Act that folks were discussing in the previous session. And then kind of a mixed bag since then. I mentioned that nationally, third quarter GDP was very strong. The manufacturing sector has been pretty strong, although it's mixed in that sector as well. But we're seeing in some of the indicators that the consumer sentiment that drives the economy has been a little bit more mixed. And it's anybody's guess what's going to happen with whether there's another wave of federal stimulus. So let me ask you, though, real quick before I get into some of these other indicators, what you're expecting over the last 2 months of the year. So I asked you about demand for freight in the previous 2 months. Now I want you to think ahead to November and December. And I want you to compare it to the same period last year rather than the previous couple of months. And the reason for that is I know a lot of you are heavily seasonal, either up or down this time of year. And so I just kind of want you to tell me, do you think comparing to November, December 2019, is it going to be significantly lower? That's going to be A. A little bit lower would be B. Just barely, so just barely lower would be C. And then flat would be D. If you're expecting any increase at all, that would be A. So I've kind of, this isn't really symmetrical because I want to kind of have more categories for decline. So declining a lot, declining some, declining a little would be A, B, and C. It looks like kind of an even balance between people expecting some moderate decrease compared to a year earlier, and those expecting those expecting things to be fairly stable. But then a decent chunk of you are chiming in saying that you're expecting some growth in. And again, I think this is noteworthy because I'm asking you to compare the last 2 months of this year to the last 2 months of last year, which is, of course, pre-pandemic. And so I think that's a pretty good sign. Looks like the majority, or at least the plurality of you, are telling me that you're expecting things to still remain down from last year. Nobody in that kind of sky is falling category though in chiming in with an A there. So I think that's kind of interesting. I'm going to do a couple more of these here. Oh, I'll give you just a second more to reply because we just got another one. So now an even balance between flat and down slightly. All right. Now I want you to think about the cost of freight and whether you're expecting any change in what transportation firms charge through the end of 2020. A is going to be any decline in rate. B is going to be flat. C is going to be slower than normal increase. D is going to be normal increase. And E is going to be faster than normal increase. And then if you don't know, that's going to be F. And it looks like we had one or two people chime in and say F. A number of people saying they're expecting a faster than normal increase in freight rates. Some people expecting flat and some people expecting a normal rate of increase. All right. So I'm going to give you a fair bit of time to chime in on this one because like I mentioned, the Federal Reserve, we're the monetary policy authority. This is often kind of referred to in the press in terms of raising and lowering interest rates. But this is kind of one of the two main levers of macroeconomic policy. And like I mentioned, we have two focuses that Congress has given us in terms of what our goals are for making policy. One of them is keeping inflation under control, and the other is keeping the labor market strong. So we pay a lot of attention to prices because we influence the supply of money in the economy. If the supply of money grows too fast, then we start to see inflation, and we don't like to see that. Deflation is actually bad for its own reasons. I'm happy to talk more about that if anyone has questions about monetary policy, but I know that's maybe a little bit far afield from what you'd like to hear from me about today. So it looks like the most frequent response we're getting here is people saying that they're expecting a normal rate of increase. Nobody's saying they're expecting rates to go down. A number of you, though, expecting a faster than normal increase. So thanks for chiming in on that. I'm going to ask about one more thing because I've been talking about labor market conditions, and I want you to tell me what you expect to happen next year at your firm with wages. And I've given a lot of leeway for decreases in wages. I'll talk more about that in a second, but let me just to read through the categories. If you're expecting a big decrease in wages, that's going to be A. If you're expecting a moderate decrease in wages, that's going to be B. Any decrease would be C. No change in wages is going to be D, and any increase is going to be E. So this is a little bit different than the kind of way I would usually break down these categories because times are a little different right now. And so one thing that's really noteworthy is we started to see a lot of firms during the pandemic cut wages. In some cases, cut wages a lot. And they did this in a lot of cases to keep people employed, to keep people on staff. But that's not something we see in normal recessions. In a normal recession, there's this whole economic theory about why we tend not to see wages go down during recessions, unlike other prices that respond to supply and demand. Employers tend to respond by cutting staff rather than cutting wages. And so it's really noteworthy that we saw, at least in the early phase of the pandemic, a lot more employers cutting wages. So we're interested at the Fed in whether or not this is a temporary thing and we're going to see wages bounce back, or whether this is going to be kind of a permanent change or even something we might see continuing into the coming year. And it looks like only a few of you are expecting any decrease in wages, 8% so far in 2021. Fairly solid majority planning to see an increase in wages, which is of course normal. And I haven't given an opportunity for you to say whether you expect wages to go up a little or a lot. But I think that's a fairly good sign. And a decent number of you expecting stable wages over the coming year. Looks like a few more of you expecting to see some growth in wages. So again, thanks for chiming in on that. It's good to see. I'm gonna get into again some of our indicators of economic activity that we've been turning to just because of the slow rate at which the normal data come out. So we have a dashboard that's up on our website. I've mentioned it probably a number of times already, minneapolisfed.org, where we're tracking some indicators that we can track on a weekly or even daily basis in some cases. These are job postings on Indeed. We've been able to get data from them, kind of an indication of what sort of labor demand is looking like right now. Minnesota is going to be that kind of dark blue line. It's actually the one at the bottom in this category. So this is just year over year percentage change terms. So not surprising, you go back to March of this year before the lockdown, and we saw growth compared to a year earlier. And then we dropped into really strong, really severe negative territory. And so we've seen some rebound in the number of job postings off of that trough where we were earlier in the year, but at least in Minnesota and nationally, still well below where we were a year ago. Montana is apparently in a different category. They're actually up from a year ago now. And this is, again, maybe not surprising, but I think it's interesting to follow it on a kind of ongoing basis. So as I mentioned earlier, I kind of want to challenge some of the narrative around the virus, which is that the primary economic impact has been due to lockdown measures that were imposed. And this is something that my boss has been out there kind of trying to communicate, the Minneapolis Fed president, Neil Kashkari. He's been delivering a message that, a large part of the majority of our economy is driven by consumers. And so consumer sentiment has a huge effect on economic activity. And right now, what we're seeing are a lot of indicators that that consumers are still reluctant to sort of go out and spend money in the ways that they used to. And that probably has a lot to do with risks that are posed by the virus. And I'm going to show you some indicators that kind of support that case. And so the sort of, if you believe my story, the corollary to that is we're not really going to see a strong economic recovery until we get the virus under control. Not a very promising message to be giving you right now, where we're starting to see a record number of new infections daily in the United States and also in Minnesota and some of the surrounding states. Very concerning, the turn that the virus has taken in the last month or so, and I'll walk through some of these. Minnesota's actually doing a little bit better in terms of new cases than some of our neighbors, but still fairly concerning growth if you look over the recent weeks. So one of the things that we track on this dashboard on our website is both the number of new cases and on a moving average basis to kind of smooth out some of the noise. And then also the number of tests that are positive, the positivity ratio. And what's noteworthy is not just that we're seeing a lot more new cases, but if you look at that positivity ratio, the point that I want you to take away from this is the growth is not necessarily due to more testing, because the percentage of tests that are being taken, a higher percentage of them are showing up positive. So it's not just the case that we're doing a better job testing and therefore it's showing up in higher cases. More people, at least among those being tested, are testing positive. So this is kind of a concerning sort of new growth phase that we've seen the last week. And of course, some of you probably know that our nearby states, North Dakota and South Dakota, have some of the highest infection rates in the country right now. And you can see that reflected in this chart. Some of the other indicators that we track on our website are, and again, I'm just showing you a small share of this. I don't want to take up too much time, but we show some indicators of mobility that we get from cell phones. So obviously, almost all of us have smartphones now. If you have your location turned on your smartphone, the cellular provider, whether it's Apple or Google, can track sort of the destinations that you're going to. We are able to get these sort of anonymized, so we're not following individual people, just kind of aggregates, and we can show foot traffic to places like restaurants, grocery stores, recreation destinations, and here I'm showing you bars. And what you can see is over the last few weeks, downward trend in people going to bars. And now we know that the state of Minnesota just announced some its newly imposed restrictions on bar closing times and things like that. But this trend in downward visits to bars just started in the last few weeks. Now, it's not surprising if you look back at the first month or so of the pandemic, we saw these kind of fall to zero, and then some recovery after things started opening back up. But it's worth noting that our neighbors in South Dakota didn't really impose the same kind of dramatic shelter in place restrictions. They took actually one of the most laissez-faire approaches in the country, and yet you still saw a big dramatic decrease in people visiting bars. And if I were to show you restaurants, you would see something similar. And some faster recovery in that state, but still kind of not really out of line with what you saw in some of the other states. And now that we're seeing this surge in new cases, people are deciding to stay at home. This isn't necessarily because the government is making them stay at home. People are looking at the risks and making their own assessment. And so this is again kind of I'm making a case here that really this is being driven by individual decision making. And I wouldn't expect this to change until we start to see the virus get under control again. If you look at the chart on the right is going to be seated diners at restaurants. We get reservations from Open Table, and I'm comparing Minnesota and Minneapolis. And again, we've seen some kind of downward trend in that since earlier in the summer. A lot more I could say about that, but I want to leave a few minutes for questions here at the end if there are any. And again, I'm just the case that I'm making here. Consumer spending is 2/3 of the economy. Consumers are making their decisions not just based on government policy, but based on their assessment of the risks that are out there. And so we don't expect to see a strong, robust recovery until the virus gets under control one way or the other. I think that's part of the reason why the news on a potential promising vaccine was greeted so positively the other day by the markets. And I'll kind of leave it at that. Again, just to kind of put a plug in for our website. The last thing I want you to do, this will not display the results. So I want you to give me some feedback on how informative you thought this presentation was. If you could just take a moment to chime in. A, if you thought it was really lousy. B, if you thought it was below average. C, if you thought it was okay or average. D, if you thought I did a good job. And if you thought I really hit it out of the park, please chime in with an E and just kind of let me know what you thought of the presentation, because I will take your feedback and try and use it to improve my material. So please feel free to be honest, because your responses are not going to be shown on the screen there. And I think I still have about 10 minutes left, so I think that's a good time to maybe see if Margaret, if you have any questions from the audience that have come in the chat.
Okay, well, thank you very much. Let me see here. I don't see any questions in the chat.
Okay.
But thank you very much. That was really, really informative. And I know lots of people are, really wondering what next year is going to bring in terms of jobs and especially in infrastructure. And a lot of it does depend on federal and state funding, but it's really interesting to see what's been happening and kind of the bigger picture on the economy. So thank you so much for this.
Yeah, and let me just actually go real quick. I'm just going to pop my email up on the screen there. If anybody has any questions about something I said, if they're interested in having me speak at a different event or having one of my colleagues speak, I'm happy to work with you on that.
So now we're going to move into the construction forecast portion of the program, and we're going to start out on the local level this time. We're going to hear from Mark Breezy with MnDOT in the State Aid Office. And I know lots of folks are interested in kind of the process of how the funds are going to be distributed for local roads and bridges, and kind of what they're looking at as far as state aid for next year. And then we also have Jody Tyke from Stearns County, who's going to talk from the perspective of the county engineers about some of the needs that are still out there and how we're working through the Alliance to try and update the assessment of the unmet needs that are out there, since so many folks have been relying on the TFAC numbers since 2012. We figure it might be time to try and get a little better estimate of what are the projects that are out there that still need funding. So if Mark is with us, if you can just say hi, Mark.
Hey, good afternoon, everyone.
Great.
I'm going to start my video as well. See if I can share my screen here.
Yeah, if you need to, I can make you a host. So let me go ahead and do that, and then you should be able to share your screen. Oh, there you go.
All right, everyone see my screen?
Yes, we can see that. So thank you.
Excellent. Well, this will be a relatively quick update here. And if you'd asked me how long the update would be about a month ago, I would have told you it'd probably be about a 30-second update because I wasn't real optimistic that we were going to get a bonding bill passed, but we did, which is great news. So the 2020 law's 5th special session, Chapter 3, Article 1, Section 16, was signed into law on October 21st by the governor. It includes $75 million for the local road improvement program. That's the general solicitation. Includes $30 million for the local bridge replacement program. And I'll go into a little bit more detail on each of these. And then $3 million for the Safe Routes to School program. There also were 26 local agency transportation earmarks that total about little over $166 million. There were 3 bridges that make up $56.2 million, including $52 million on the Kellogg Boulevard Bridge, and then a couple ped bridges that Margaret referenced earlier, one in Rogers, one in Shakopee. And then there are 23 road and trail legislatively selected projects totaling just under $110 million. So the local road improvement program, we've got, as I mentioned, those 26 earmarked projects, which I think is an all-time high. I sent out letters to all of the recipients of those earmarks, and I see that there are a couple at least here on the call today. And I probably met with maybe on the order of 10 to 12 of them already. These letters, this is really the first time that we've done this from state aid, but we send these selection letters out on the competitive LRIP program, but we hadn't done it on the earmarks. And it's probably even more important on the earmarks to get together early and to talk about the appropriation, talk about how funding works, talk about roles and responsibilities, make sure that the local agencies understand how this demonstration of full funding works. And if you don't know anything about that, in a nutshell, the dollars that are appropriated go to the Minnesota Management and Budget Department first, and then the local agency needs to be able to demonstrate that all of the funding is in place for whatever work types are identified in that particular appropriation. So if it's $5 million for design and construction, the local agency would need to demonstrate that all of the funding, the $5 million in bond funds plus whatever other funding is required, is in place for both design and construction. And so when Minnesota Management and Budget concurs with the demonstration of full funding, they check a little box in a virtual manner, and that releases the funds to MnDOT, and that's what allows me to execute grant agreements. And then in those selection letters, also I mentioned a little bit about the grant agreement process in general. We have, as I mentioned, $75 million for the competitive local road improvement program solicitation, which is really great news, and that also is an all-time high. I don't know if folks can see the little figure I have here, but we do have that solicitation in development in state aid. So the governor, if you're starting on the left of that little figure, the governor signed the bill into law on October 21st. I should mention too, with the earmarked funds, regardless of when that demonstration of full funding occurs, and regardless of when local road improvement or local bridge replacement grant agreement is executed, any eligible costs that are incurred starting the day after enactment, so on October 22nd moving forward, all of those eligible costs can be reimbursed. So that's another piece of news that I make sure to share with all of the earmark recipients. We have the first meeting of the Local Road Improvement Program Advisory Committee scheduled for November 18th, which is a week from today. And representation on that committee includes a couple city representatives, a county engineer, a city engineer, and then a county commissioner. Those are the 5 that are identified in statute. But then we also include involvement from the Transportation Alliance. So Margaret will be a part of that meeting. We also have Association of Minnesota Counties covered, League of Minnesota Cities, Minnesota Association of Townships. I think we have Micah on that committee as well. And so what we do, really, the intent of the first meeting is to finalize this, the application for the competitive grant and also the solicitation guide. So assuming that, I don't get any kind of major comments from that group next week, I anticipate releasing the application in early to mid-December. We'll probably give local agencies about 3 months to pull together applications for that, which would make applications due first part of March, early part of March, or mid-March. And then depending on how many, I think the last time we had a solicitation that had funding, we had about 200 applicants. And based on the amounts of contacts that I've had probably in the last month or so, I think there's going to be a lot of interest. I know that there'll be a lot of interest in this program. And I would anticipate that we, at least have 200 applications and maybe more. So it's going to take a little bit of time for us to get through at state aid, to get through all the applications and rate them and evaluate them. And then the idea would be that we would bring our preliminary recommendations to the LRIP Advisory Committee for meeting number 2 that would occur sometime in late April. And we would anticipate having award announcements there in May. So in a nutshell, that's what we're planning on doing with the Local Road Improvement Program. For the Local Bridge Replacement Program, there were $30 million in bonds provided from the bonding bill. And then when coupled with the $11.2 million that we also receive for local bridges from the motor vehicle lease sales tax, we get 13% of the motor vehicle lease sales tax that we get to apply to local bridges and rehabilitation projects. We'll have on the order of $41 million, a little over $41 million for local bridges. We do have, as most people are aware, we have a waiting list. We have a very large list which identifies all of the priorities statewide, but then we have a subset of that list, which we call the waiting list, that are projects that have plans either complete or very close to being complete. And we've got on the order of $60 million worth of requests for state bridge funding on that waiting list, projects that are just ready to go. And we've only got about $41 million in state bridge funds. So unfortunately, we're not going to be able to fund all of the projects on that list. But we are working with district state aid. When I say we, I mean Patty Loken is working with the district state aid engineers and local agencies on prioritizing funding for projects. Safe Routes to School program. I was really excited here to get $3 million, which, when you compare it to 75 million in local roads and to 30 million in local bridge, it doesn't feel like a lot, but it really is a lot. Over the life of the Safe Routes to School program, we've gotten about $2 million in state funding over the entire life, which is, 15 years. So we're getting $3 million now. We're really looking forward to this. State aid will be working in cooperation and collaboration with the Office of Transit and Active Transportation to determine the plan. So I don't have a whole lot to share on this program beyond the fact that we probably are going to be looking into fall of 2021 for a solicitation. There are a bunch of reasons for that, but probably the biggest reason is that there's a Transportation Alternatives federal solicitation that's on the street right now. I think letters of interest have been submitted, and the Office of Transit and Active Transportation, along with someone from my group, are reviewing those, and we'll be asking some agencies to submit full applications. So I think the awards are planned to be announced for the federal process in April. So we don't want to release a solicitation for state funding while the federal solicitation is active. We also have some safe routes engineering studies that are underway throughout the state, and those are anticipated to be complete in the early summer of 2021. And those really probably will be really great candidates for the infrastructure funding out of the $3 million. And so we just felt it would be better to wait until the fall. That way we can release the state solicitation concurrently with the next federal fiscal year solicitation on the federal funds. So that is my update, like super quick. If there are any questions, I'd be happy to take questions. I think Margaret is looking for folks to type in any questions into the chat box. So I'll just wait to see if there are any questions.
Yeah, thank you so much. That was great. And I think that was exactly the kind of information people were looking for. And of course, we'd love to get your PowerPoint presentation to put up on our website afterwards too.
Certainly, yep.
So I don't see any questions in the chat. I guess one question, I'm assuming that with this new funding and the new solicitation, it'll be sort of, starting with a blank slate. I know there was a solicitation, even though there wasn't any money for the local road improvement program. Is that kind of what we should expect, that any previous solicitations won't really be an issue with this one?
Yeah, that's a good question. So I've gotten that question from a couple other applicants from the 2019. So we did have an unfunded solicitation, and solicitation is probably the wrong word, but I'll use it anyhow. We had an unfunded solicitation for the local road improvement program in 2019. And the primary reason for that was really just to get a feel for what kind of demand there is out there, so we could use that for lobbying purposes. And we got, I don't remember exactly what the number of applications were, but it was on the order of about $100 million worth of requests for local road improvement funds. And if I'm county A or city B, and state aid says, hey, we're looking, put together these applications, we don't have any funds available, I might not put together an application. So I know that the demand, while we got a request for $100 million worth, I know that the demand is much higher than that. Having said that, for the applications that were submitted, then the new application for 2020 will be slightly different, number one, than the application that we had in 2019. But number two, and probably more importantly, we really want to make sure that we get up-to-date cost information on these projects. So some of these projects that were submitted in 2019, maybe the scope has changed. Certainly the costs will have changed. And local agencies, if they so choose, they could just take their cost from the 2019 version, apply, a construction cost index increase to that, and resubmit. But we are going to ask that any applicants from 2019 do refresh their applications and resubmit for consideration in 2020.
Thanks. That's good. And hopefully for the folks who did submit in 2019, they'll have a leg up and be ready to go, because it is really helpful when we do get feedback about what's out there, what's needed, what the rough costs are. So definitely makes a difference with legislators when you can point to specific projects when we're asking for a dollar amount in the bonding bill. So here's a question. How long is the waiting list for bridges that need to be repaired? And does MnDOT reevaluate the structural safety concerns to change that waiting order?
Good question. So we don't really, as MnDOT, we don't evaluate or reevaluate the status of the bridges. They're local bridges, and so really the local agencies would update those update those plans if they need to be updated with current specifications, or if a bridge is closed, for example, if it has a local bridge planning index of 50 and needs to be closed to traffic or posted load restrictions, those local agencies typically will come to us and let us know. And that, something like that, like a bridge being closed, depending on how much traffic it carries and what, purpose it serves for the local economy, et cetera, that can bring it right up to the top of the list. So there's a lot of different things that we look at in prioritizing projects. Condition of the bridge is certainly one of them. We do like to fund projects that have been on the waiting list the longest. So we do consider first in, first out, though that isn't the only thing we consider. There are a lot of projects that have either federal funding or like federal bridge funding or off-system bridge funding that also is federal. And you know, we don't want to put those federal funds at risk, and so we consider other sources of funding as well. And then there are a few other things that we consider on top of that.
Okay, well, it looks like that's about it right now. Oh, wait, we have a question in the room. Turn the microphone on.
Mark.
Hello, yeah.
Hi, Michael Potter, Commissioner from Wright County, also former chair of the AMC Transportation Policy. And this has reference to safe routes to school. Okay, and I'm thankful for the 3 million, you know, asked for, Governor wanted 10, 3 is still a good number. One of the questions that came up before is if they change the policy from it's a minimum of $100,000 project to get funded. We came in with some school districts where the school had moved a little bit and only had a little gap and the project didn't add up to $100,000, so they couldn't apply for these money. Is there something in there that can modify that so these other smaller, some districts can actually access that money? That was a question.
Could you tell me a little more about that? So I have not gone through a safe route solicitation in the past. Are you saying that projects previously have been required to have a max or at least $100,000 worth of work? Is that what you're saying?
Correct. That's what it was before. And the question was, with some districts, say they move a school a few blocks and all it is a small gap, but they're still smaller, poorer districts. They just said, well, that doesn't do us any good. If it turns out to be an $85,000 project, we can't apply for this. So my thought was maybe you could take it into a multi-tier situation where some under 50, between a 50 and 75 and 100, whatever works out there, to try to catch some of those schools that are having a hard time with that. I know Safe Routes to School, I'll say just pick on Rockford School District. It's not that far from where the sidewalk ends to the school, and they can't apply for it because it's just under $100,000. STMA School District, where I'm at, Albertville, the sidewalk was, you know, it was 60 some $1,000s, and they just paid for it themselves because they couldn't apply for this funding. And it was just one of those, these are gap moments. And I think Foley School just got one, but they expanded the darn thing just to make sure it met that $100,000 thing, you know, and don't really want people to do that, but you still want to make sure that people have access to that safe routes to school.
Well, thank you for that comment. I will pass that on to the team that will be putting together the solicitation. You know, like I said, we've got $3 million here. So I think there's certainly an opportunity to lower that, to look at lowering that, having a couple different tiers. You know, those, maybe we target 500,000 for those projects that are 50 to 100,000. And then we target the remaining portion for those that are in excess of 100,000. I don't know how that exactly would work, but I think it's a great comment and one that I will pass on to the team.
Okay, great discussion. So now I'm going to turn it over to Jody Tyke. There we go. Now it works.
Let me just get this here. All right. So as Margaret mentioned, I'm Jody Tyke. I'm the Stearns County engineer. And about a month and a half ago, we were discussing wanting to find out what those needs were because, of course, everyone references that TFAC report. But then also the industry kind of wanted to know how the COVID revenue decrease caused by COVID rather, how that would be impacting those local construction programs across the state. And so we did send out a survey, and a thank you to everyone who sent responses to that survey. I just do want to put in a plug that if you haven't responded yet, we're still going to be using this information as we go to the legislature this coming session. So feel free to please continue sending in those responses if you still have that survey. So for a little background, before COVID ever was even known, AMC and the Minnesota County Engineers Association worked together in an education effort, I guess, for lack of a better term, to determine what that actual funding shortfall was for counties as we moved forward with lobbying for transportation funding at the legislature. So using the TFAC report as a basis and then the county state aid highway needs system to corroborate the scale of the problem, it was determined it was approximately $450 million annually for that CASA system, and then $450 million annually for the county road system. So now fast forward to the era of COVID, and we were told back in May to estimate that there would be a 15% drop in state aid revenues due to COVID. I know that this morning when Josh presented, it looks like that may be closer to 11%, but at the time of budgeting for most counties, we used 15%. One thing that's important to note on that is when our state aid revenues are allotted to all the counties, 60% of that is for construction, and 40% of that goes towards maintenance and operations on our state aid system. So generally counties are already subsidizing maintenance and operations on their state aid system, but now we're taking that bigger hit of a significant source of revenue for those maintenance and operations. So as we surveyed counties to find out, what are those funding needs now? Where are we? As we always hear, there's an ongoing need for bridge bonding for all local jurisdictions, townships, small cities, large cities, counties. And as Mark just mentioned, that the latest bridge bonding amount that was allocated doesn't even clear the queue on the waiting list. And of course, new bridges are added every year as those annual safety inspections are completed. We should also consider that locals spend a lot of money on state projects, whether that be the cost participation policy related to interchanges between county roads and the state trunk highways. But MnDOT also has a funding shortfall. We need to recognize that. Especially in the metro area and those ring counties, those counties spend a significant amount of their sales tax money or other local revenues on improving some trunk highways because those counties do recognize that those are some of the worst efficiencies within their counties. So as a result, a lot of projects are getting deferred, which we all know equates to a higher cost. Either the fix has to be something much larger or it's just inflation. There's also a demand to accommodate all modes. Simple resurfacings, now those projects include significant ADA upgrades. Oftentimes the locals want us to look at putting trails or additional sidewalks, and by locals, I mean small cities, adjacent property owners. They want to look at trails, they want to look at sidewalks. In the metro area, we of course look at bus rapid transit. All of those things add to everything that falls on the county's plates right now. So let's look at impacts to 2021 and what the counties are going to be doing. I'm going to start with maintenance. A lot of counties, because we can't just quit plowing snow, we can't just quit patching the potholes in our roads. Counties are looking at, they either have to increase their local funding that goes towards those maintenance and operations, or they have to defer some larger maintenance projects. Some counties bid out larger maintenance contracts for seal coat or crack sealing or other, minor overlays, contractor patching, that sort of thing. Some of those larger contracts across the state, county engineers have said they're going to have to defer that to make up for some of that. Other counties are just saying they're going to have to increase their local funding because they can't cut back anymore. There are several counties that are using local levy money that normally would go towards construction projects, and they're cutting back that amount of construction and using that to subsidize the maintenance and operations rather than having that declining level of service. State aid has given counties and I believe cities an option to do hardship transfers from their construction fund to be used toward maintenance, and that's a whole process I won't get into. But most counties are agreeing this is going to have a domino effect into the future years. So many contractors want to know how that decreased revenue or projected decreased revenue will impact our construction programs that we've all had. Again, we're seeing a lot of counties saying that they've got to increase their local funding rather than delay those projects. That might be their sales tax funding if that's coming in at a decent level. I know in Stearns County, we've been pretty fortunate. It's a very slight drop, only over a couple of months from what our 2019 revenues were. And I think a lot of counties are seeing that same thing. There are several counties that are going to bond, but sometimes we have to delay projects just because we've got to make up that difference in the state aid funding projected shortfall. And so counties are going through prioritizing those time sensitive projects, reconstruction where you have right of way or temporary easements or federal fund project matches, et cetera. So they're prioritizing and then delaying that. Quite a few counties were fortunate to have the ability to advance state aid construction funding at this point to try and keep our programs on schedule to some extent or as much as we can. However, if every county in the state decides to do that, some of those projects are going to get delayed. And again, much like maintenance, there's a potential for this domino effect to go over the next several years. So when we asked about unfunded needs, we got answers all over the board. It's not surprising, I guess, that there are a lot of state highway improvements that county engineers focused on. And as you can see, I'm not going to go through all of these, but these are just a few examples. And these are throughout the state. This is not unique to the metro area. It's not unique only in rural Minnesota. Throughout the state, we all recognize that there are a lot of significant projects that really need to be done on the state highway system. But on top of that, of course, we've got our local needs. I mentioned the funding shortfall pre-COVID that's only gotten worse. A lot of major reconstruction projects, a lot of resurfacing that needs to be done. I'll bring up again, bridge replacement, interchanges. So again, we have those unfunded needs in rural and urban areas. It's not anything that's unique to one part of the state. And so that's all I have. I just wanted to give you a brief update. If you have any questions, you can certainly let me know in the chat box separately, but otherwise I'm sure most of you want to focus on what MnDOT has to say too.
Okay, thank you. That was great. And I just want to also stress that with our survey, it doesn't matter what area you are in particularly. We're just looking for your insights in your part of the state. So if you're a county engineer or city engineer, if you're aware of an issue on the state system, if you're aware of an issue in a different mode like transit or ports or freight rail, we want all that information. So don't feel like, if you're with a county, you can only talk about county needs. We're also looking for just folks who know what's going on in their part of the state to tell us. And so also if you're a consulting engineer, a lot of folks are aware of projects that are the needs that are out there that aren't funded. Or if you're a supplier, kind of anybody in transportation, we're just looking for your ideas, thoughts, projects you've heard about, needs that you see that are going unfunded. And we'll send the survey link out again, but we would really, really appreciate folks helping us out with that. Okay. So we're going to move on now to the state highway construction program. And for this, we're going to hear again from Josh. And if I can find him in here. Oh, there he is. I'm assuming he's probably going to want to share his screen. So can you do that, or do you need me to do something?
Looks like I can.
Okay, great. I will turn it over to you.
Great. Well, hello again. Josh Knetter-Hubinger, MnDOT Budget Director. Margaret, I don't know if did this the SRC Outlook get shared with the group before?
Yes, we emailed it out, and folks here have it in their packets.
Great. So my intent was just to quick skim through that, what we like to call one-pagers at MnDOT. So it's about 7 pages. Just summarizing kind of our current outlook for the state road construction program. This document is very similar to the versions we prepared in the past, so hopefully it looks pretty familiar. I'll just hit some high points and then obviously leave some time for questions if there are any. So first off the bat, we highlight the new money we got in the bonding bill. This is just trunk highway specific. So you can see again those 5 pots of money that total $500 million in the top left corner. So that's 110 million for railroad grade crossings. It's the language doesn't call it out, but it's essentially for 2 projects, Moorhead and Anoka. There's 23 million for flood relief in District 7. There's 25 million for developing projects for future actual construction. There's 84 million for state road construction. And this is what we talked about a little bit this morning, where the first column, those dollars are to keep any projects on track that would get delayed due to COVID-19 impacts. So again, we are going to wait until after the November forecast to see what those potential impacts are. So then we'll know more what that 84 million will go towards. And then we also got 58 million for specific truck stations construction. I'm not going to read through these bullets one by one, but I will just down in the bottom left corner on this page, it details by district what the actual program looks like for the current state fiscal year 21. These amounts include the bonds we got back in 2017, those Chapter 3 bonds. So those in total over the 4 years that those are spread out, it's about $640 million. So you can see 246 of that 640 is programmed in 21. In total, a little over $1 billion in state road construction, both state and federal. And again, that does not include quarters of commerce. You can see the very large amount in District 1, that's for Twin Ports. On the right, on this first page, I'm just gonna get rid of that. We do highlight the performance measures kind of for current state in 2020, what the targets are that we've identified in MnSHIP, our long range plan, and then where we think we'll be at the end of the current STIP. And so you can see in terms of bridge condition, holding serve basically for NHS poor, but it's still above the target of 2%, but holding pretty stable to current. Same for NHS good, kind of holding serve, but below the MnSHIP target. On non-NHS poor, we actually make a little progress, getting a little under 3%. So that's actually beating our target for now. And then on non-NHS good, again, kind of holding serve, but under our target. Looking at pavement condition, a little bit of a different story. So on the interstate, right now, we're currently under the MnSHIP target of 2% at 1.3%. That is projected to deteriorate a little bit. So at the end of 24, getting to almost 3%. Same story for non-interstate NHS, and same for non-NHS. Just we're not keeping up for pavement condition. The next page is a comparison of what was in the CHIP guidance for the next 10 years. So the CHIP is the 10-year plan. And you can see this is broken out by those different categories that are identified in our MnSHIP and our CHIP. The green is the kind of system stewardship areas. The light blue are the critical connections, such as the mobility both in Twin Cities and Greater Minnesota, also freight and bike and ped, and then the various other categories. And the high level point here is you can see over the next 10 years, the CHIP guidance estimated a little over $10 billion in funding, broken down into the categories this way to hit our performance measures and our objectives. And then down below, you can see here's our current plan. So this is kind of the more revised estimate of what will actually happen. You can see it's a slightly larger number, and that's due in large part to the quarters of commerce bond funds we received. That's $800 million between 2017 and 2018 we received for quarters of commerce. And in general, the breakdown between the different categories is fairly similar to the CHIP guidance, with a couple exceptions that are noted on the right. So pavement condition, the investment goes down a little bit due to those additional bond funds and some additional bridge needs. The safety area, that orange, is up quite a bit due to adding some more safety projects. And then the Twin Cities mobility goes up quite a bit because of those quarters of commerce projects. The next page, this is just that standard construction outlook where we break down the total funding for state road construction, and it identifies the various pots of money. It's a kind of easy way to see we tend to have a pretty large amount of funding, but it's in these kind of large one-off chunks, and so it's hard to do long-range planning. You can see on the far right Once those new bonds we received in 2017 and 2018 go away, that base funding out in 2024 drops down quite a bit. Now, again, the history there is typically by the time we get there, we'll maybe have some more trunk highway funds that we can request additional legislative authority for. But right now we have to plan based on how much we currently have in the appropriations bill. Then there's just a little breakdown for the next 4 years by those large investment categories, and it's fairly stable. The big change, as you can see in 24, the total goes down quite a bit. Then there is an itemized list of the large projects just for the next 2 fiscal years, so anything over $15 million. And the 2 large projects that stand out, Twin Ports, you can see the second and third row, both Twin Ports. So in total, about $275 million for Twin Ports. And then down a little bit, there's $173 million for the 494 project. Those are kind of the 2 fairly significant projects going on in the next 2 years. This list, the next list is the 7 quarters of commerce projects that were selected. No change here. Has a little information on the likely contract date. So again, that reminder of, even though the funding for these projects was received in 2017 and 18, the actual delivery and construction takes quite a bit of time. So you can see like the 252 I-94 project isn't scheduled to be let until 2023. And then there's a little update on inflation. So this is relatively hot off the press. You can see there's a chart detailing the last 20 years for MnDOT's internal construction cost index. You can see on average, it's about 5.5%, but it jumps all over the place year to year. So really hard to plan or estimate this in any given year. In 2020, the actual inflation rate ended up being almost 6%. But you can see that was quite a bit less than the last 2 years where we had historically high percentages in the mid to high teens. And that was preceded by 2 years of really low deflation. So just really spiky, really makes planning long-term challenging. But again, overall, over the last 20 years, about 5.5%. And then below, this is just the updated guidance now for the next couple of years on what we think by year that inflation will be. The estimate is that there will be some deflation in 2021 due to the combination of things like low oil prices, the low interest rates at kind of every level. So potentially some good news there, and then it reverts back to that more long-term average trend of in that 4 to 5 range. And before I move on to this last chart, I just want to show you one more document that we do share in a variety of sources, but just so you can see the impact of that inflation. What's on the screen right now is just the bars are the nominal dollar amounts collected in the HUTD fund by year, going back to 1980. And so up through 2020 are actual revenues, and then 21 through 23 are projected estimates. Those red bars are kind of significant changes in funding. So you can see that gas tax increased back in 1989, going from 17 to 20 cents. The Chapter 152 funding package that started phasing in 2009, and then getting those new general fund dollars in 2018. And then you can see that kind of drop off from COVID-19. But despite those kind of significant boosts in funding, that red line is the inflation adjusted, and that's adjusted to that construction cost index I just walked through. You can see we actually have less money over the last 20 years. The revenue has grown about 3.5% per year, but inflation has grown about 5.5% per year. So even though we've had a big funding package and some additional funds dedicated in the last couple of years, over the last 2 decades, we actually have less money in terms of real buying power.
Hey, Josh, we're seeing the debt service level.
Oh, sorry. I need to actually share that other one. Apologies. Thank you, Philip. Try this again. Will that make a little more sense? Apologies for. So what's on the screen? I will just quick run through this again. So this is just blue bars are nominal dollars that are collected in the HUTD fund. The red bars are highlighting those significant changes I was just going through. And then the line is the inflation adjusted revenue. So again, that you can see that peak in the kind of mid 2000s, and then the combination of some relatively high inflation years and then just revenue not keeping up with inflation. We actually have received less real dollars over the last 20 years when you adjust for inflation. All right, sorry about that. And then I'll just quick jump back to that one pager and end with where we're at for debt service. So MnDOT has an internal debt service policy that the debt payment in any given year can't exceed 20% of the state revenues in the trunk highway fund. On the screen right now is where we were at the end of session, the last time we published a formal update. And so you can see here the peak was in fiscal year 21. A little under 17% compared to that 20% peak. And that's with a debt service payment in fiscal year 21 of 238 million. A couple caveats here. This does not include the 300 million we just received in the most recently passed bonding bill, but it also does not account for the low interest rates we received in our last bond sale in August. And it does not include the savings we're going to receive over the next 2 years from refinancing some old debt. So those two factors will skew this quite a bit when we update this for November. So this is the last formal number. We're kind of close to that limit, but still some cushion, which is why we were comfortable accepting that 300 million of new money. But this will look very different after November. And that is all I had. Open to questions.
Okay, thank you. I just really want to thank Josh so much because this is such a great handout. I just love getting all this information every year and really appreciate all the work that you put into this. It's super helpful to have this when we're talking to legislators so they can really understand the revenue picture. We do have a question in the chat. In just a couple of years, Candy-Ojai County will be 2 million short on road funding necessary to maintain our infrastructure at its current state. As a regional center, we may be able to make up this shortfall by extending a local option sales tax initiative that expires in a couple of years. However, how do counties that are not regional centers deal with the shortfalls? So I don't know if anybody has anybody.
Margaret, Margaret, this is Roger. That was sort of a rhetorical question because I think we all know the answer to that. It's proper funding from the state. Sorry.
Yeah.
Thanks for letting me.
That's okay. Yeah. No, I mean, it's a good point. We know that with the local option sales tax, it's created some winners and losers to a certain extent, and it's not the most ideal tool, but it certainly has made a difference for a number of counties as they're dealing with their system. But it's a good point to remember when we're talking about why we need more dedicated state funding. Okay, so I did want to ask Josh one quick thing. We've been hearing for a number of years about a bridge bubble on the state level that's coming, and it seems like it's always this ominous thing that's sort of coming. Do we have any updates in terms of when this bridge bubble might be coming and how big it might be? I imagine it includes the Blatnick Bridge, but can you talk a little bit about that?
Sure. Well, and this might be a great segue to open it back up to Philip. I think he might be a little more appropriate to speak to it. But yeah, it's kind of the middle of this decade is when it starts, I would say. So Philip, correct me. But yes, Blatnick is a big one. Dunwoody is a big one. And they're fairly significant. Just those two, obviously, are pretty big dollar amounts. Anything to add to that, Philip?
Yeah, I was just going to actually try and pull up the forecast. It might take me a second to find the file I wanted to find. I think Blatnick complicates things because the size of the bridge is so large that it eats up several years of funding for our bridge program. And sort of doesn't allow us to do work on almost any other bridge at that and over those years. I think we're hopeful that we can have a conversation with the legislature about bonding for that and some other opportunities to help fund that project, and it's still being evaluated as to exactly what we're going to do there. So there's a big unknown factor about exactly how much that bridge is going to cost, and in our discussions with Wisconsin, because it's a joint collaborative project. But yeah, I think the later part of this decade is when we start to see the edge of that bubble, and then it sort of accelerates into the next decade. So that is sort of the current state, and I can see if I can't find a more specific answer, but and maybe I can look that up after I give my presentation while Nick is talking.
Okay, great. Okay, so I think we'll move on then to Philip, and we really appreciate him being here. One topic that has been kind of a hot issue at the legislature in recent years has been the issue of project selection. We know that a lot of legislators think that there's some big black hole of kind of mystery about how projects are selected. And a lot of people who think that if there's plenty of money, they just don't pick my project. And so this has been an area where legislators have passed some legislation requiring more reporting, requiring more analysis and transparency about the whole process of project selection. And we know that heading into the next legislative session, this issue of the impact of COVID and people's changing travel behavior is also going to play into this issue of not only which projects are picked, but which projects are going to be needed in a new world post-COVID. So it seems like it's shaping up to be an issue that will again be talked about a lot at the legislature. So I thought it would be really good to get an update on what MnDOT has been doing in recent years to address this topic and help people understand how projects are selected. So I'm going to let you take it away and let me know if you need to screen share.
I think I can.
Yep.
Let me know if you can.
Yes, we can see it.
And can you see are you seeing which view are you seeing? The
Oh, we're seeing the notes view, so we can kind of see the next slide too. There you go.
Okay, great. Thank you. Yeah, so Philip Schaffner, I'm the Director of Statewide Planning for MnDOT. Happy to be with you here today to talk about the work we've done over the last 2 years to try and improve the transparency of the project selection process. It is, as those of you who are part of this process understand, it's complicated. There's a lot of moving pieces to this, and we have been making efforts both out of sort of legislative direction and out of some separate efforts to try and improve that. And so I want to talk through about the direction we got and what we've done over the last 2 years, and then we can talk a little bit about sort of the COVID questions about where we head from here. So going back to 2017, after several years of debate and discussion at the legislature about frustration with not understanding how we select projects at MnDOT, we did get direction in 2017 during the first special session, Chapter 3, Article 3, Section 124, that required MnDOT to develop a new policy for how we select construction projects. It had a number of different requirements. I'm highlighting 3 of them that I think are sort of the core of what the legislative requirements really pushed us towards. And one is to publicly identify a set of criteria that are used in a scoring process to score projects. And to also make a shift in our transparency. So we had historically shown you and everyone else the projects that we selected and the years we anticipated doing them, but we never really publicized the list of projects that we evaluated and had not yet selected. And that was a key piece of trying to understand the decisions was, where did other projects fall? What else did we even look at? And so that's a new requirement for us to show the full list of candidate projects and to publicize the scores and reasons associated with selecting projects or not selecting projects, as the case may be. Over the 2017 and through 2018, did a number of things. We looked at recommendations from the legislative audit on our project selection process. We did look at other states and their scoring processes that existed at the time. Those have evolved some since then. At the time, there were about a dozen other state departments of transportation that used some sort of scoring process, but they varied pretty significantly in terms of what their processes covered in terms of the types of projects and the amount of transparency they had around their process. We did form an external policy advisory group. Dale Grove, who I think is on today, represented the Transportation Alliance as part of that advisory group. And we did multiple rounds of engagement with stakeholders, going to all the area transportation partnerships and meeting with metropolitan planning organizations and regional development commissions and many others throughout that year plus of working on this. We worked with lots of people throughout MnDOT and developed and tested scoring processes for every category of project. And we did a draft of our proposed approach and scoring criteria and got some feedback on that prior to adopting the policy and beginning to implement. So we adopted the policy in November of 2018, so 2 years ago this month, and it applies to almost all state highway construction projects. We did exempt some preventive maintenance, emergency repairs, and a few other types of construction projects, but it covers most everything. We did exempt projects that were already in the STIP at that time, so the 2019 to 2022 State Transportation Improvement Program, and we first implemented this new policy with the 2020 through 2023 State Transportation Improvement Program and the 2020 through 2029 Capital Highway Investment Plan, or CHIP. There was discussion at the legislature this last spring about extending the requirements to some of our modal programs and to the local road improvement program and local bridge replacement program that did not ultimately make it into the bills that were adopted. We have been taking some of these aspects of this policy and applying them to some of our other programs, but the policy itself formally applies just to the state highway construction projects, even though we've been starting to use some of these different elements, particularly the use of criteria and scores in a lot of our programs, and continuing to evolve that over time as we learn and adapt this process of using numeric scoring and sort of publicizing candidate lists. So as part of the policy, we post all of the criteria and methodology we use for all of our project selection processes, and we do post all the scores for all the projects selected and those that we evaluated but did not select. The score itself is one of the key factors in the selection decision, but we do consider other things. So we will look at sort of timing with local projects. We will look at sort of metropolitan planning organization factors. We will look at things that maybe that might require additional review and analysis before we commit to it. There may be other factors that are sort of unique to why we would select a low scoring project, or we might not select a high scoring project. And whenever we do that, we do also provide and post a short explanation of the reasoning. The policy applies to one decision point in a long chain of decisions that end up in the projects that actually get constructed. So the project selection policy specifically focuses on the decision to put a project into the State Transportation Improvement Program or into the 10-year Capital Highway Investment Plan. It does not factor into the full project development process. So that goes into all of the details about what actually we're going to build as part of that project, and the involvement with the public and stakeholders, and the environmental process and design, how we time construction and stage it, and what traffic management we're going to use, or what contracting and delivery mechanisms. So The project selection policy is really focused on one decision point in this process, and we have other policies that and programs and processes that apply to other aspects of the delivering the actual projects and developing the details of what goes into those projects. There are also a lot of decisions that happen before we select projects that have a bearing on the projects that we do select. And that goes all the way up to the policy objectives, the strategies, the performance measures and targets that are set in our statewide multimodal transportation plan and metropolitan transportation plans like the Metropolitan Council's Transportation Policy Plan 2040. Also, Josh referenced some of the funding direction that comes from our 20-year highway investment plan that sets sort of specific goals for the amount of money for different types of projects. And we also have processes for how we distribute funding between our 8 construction districts. And that has a bearing on the types of projects and number of projects that are selected within each district. So our 20-year highway investment plan, MnSHIP, does set spending targets. These are the 20-year totals. Earlier, Josh had showed you the 10-year version of this that set a general spending amount for different types of investments, types of improvements. We also have predicted and planned outcomes that are associated with this that we are trying to hit with these investments. And so those are things that we pay attention to when selecting and programming projects. We also have a funding distribution process by which we distribute money geographically. It sort of breaks down into different buckets of money. So we generally distribute a certain amount based on National Highway System pavement needs. Those are generally federal funds, National Highway Performance federal funds. Likewise, we also distribute money based on National Highway System bridge needs, also generally federal funds. We do distribute money based on fatal and serious crashes for the Highway Safety Improvement Program. We also distribute some money based on highway mobility needs, sort of again based on where they fall geographically. Most of those go to the Metro District, given where we have the majority of our congestion and reliability issues. We do have some that are programmed to statewide programs or into competitive solicitations. But 42% of the money is then distributed to our districts by formula. That 42% is based on a formula that looks at the condition of our non-national highway system pavement and bridges, the size of our system, and then the use of it. So vehicle miles traveled and heavy commercial vehicle miles traveled. We do update this every year, although we cap how much money going to any one district would change by 1 percentage point. So this evolves over time. We do run these numbers every year to reflect changing needs, but we try to avoid major swings in funding to any given district. I'll go back to just say that we are looking at this method right now, and there's a committee that's formed that includes cities and counties, metropolitan planning organizations and regional development commissions, called the Programming Update Work Group, that is taking a look at this as well as other funding questions about funding distribution. I saw Steve Bott on here. I think there may be a few of you that are on today that are part of that group that is wrestling with whether we should be making any changes to this. But we do have a group that includes external stakeholders that helps advise our leadership on potential changes to how we distribute money. So all of that flows into then a series of selection categories. And we select projects within categories and programs, and each of these has its own scoring system. And some of these are scored within each district. So our various different pavement projects are scored and selected within each district. Same thing with our non-national highway system bridges and culverts. Any sort of mobility or capacity improvements, any standalone safety or bicycle and pedestrian improvements, and then the local partnership program are all scored and selected within each district. We have other programs that are scored and selected on a statewide basis, either through a competitive program or sort of managed through a central office. That includes our national highway system bridges and bridge culverts and pedestrian bridges, as well as a lot of the programs people might be familiar with. So Corridors of Commerce, our Minnesota Highway Freight Program, the Highway Safety Improvement Program, at least the state side of that, We also have the Transportation Economic Development Program. So those are programs that, are generally competitive. We also have centrally managed programs like our historic roadside properties, ITS, our highway railway crossings programs, our safety rest areas, standalone noise barriers, and the way station capital improvements program. Each one of these has a scoring system associated with it, and we've publicized the criteria. I'm showing a couple of examples here. So most of the programs use a 100-point scale, not all of them. The score is the relative priority within that program. So even though we're using similar point systems, they're not directly comparable. So an 80-point score in one category doesn't translate into an 80-point score in another one. It helps to show relative priority within that program or category. And so each one of these programs has a scoring system like this that you can see, and you can get all the different criteria. And for most of them, we also publish detailed scoring rubrics on exactly how points are assigned for these programs. We've now added the category and score into the State Transportation Improvement Program and our Capital Highway Investment Plan CHIP. So I just did a screen capture of our draft 10-year CHIP. This is District 7 in the year 2026. And so every project listed here has the category of the project that it was selected in and the score. So you can see of the projects that we have selected, what category they fell under and what the score was. But that doesn't tell you the whole story. So we've now built out a website, MnDOT.gov/project selection, where you can get the full candidate lists. And there are a lot of them. And so we've designed multiple ways to get to a list that you might be interested in. So you can look up by type of project. So you might be interested in sort of bridge projects, and then you can sort of look that up and you can navigate to that list. Or you might be interested in projects in your geographic area, so by district. So you can navigate to a page like this for District 1 that would show you, help you to say, okay, here's sort of, you can find a list of just what's selected, or you can look at the projects by category, those that were selected within the district, or you can get navigated to the statewide lists to see potential projects there. Each candidate list is posted online now. We have sort of a condensed, summarized version just for the web that sort of shows the total score, and then has information like the year it's currently planned and a high-level construction cost estimate and some general simple descriptive information about the project and any comments about why it was selected or not selected. But we also have detailed scoring information that you can download in Excel that shows the breakdown of the score and the relevant metrics and factors that went into assigning that score. So if you want a lot of information, it's available for all of these. The 2020 lists should be up in a couple weeks in early to mid-December. We're just finalizing those right now as we're about to finalize the STIP and CHIP for the 2021 versions of those key program and plan. So that's all available now, and we're going to continue to update as we go. Of course, that brings us to the question of, are the projects that we've selected the right projects? And this is, I think, a really important question to be asking, on a very difficult one to answer. So, it's clear that we have seen dramatic changes over the short term in terms of the rates of people teleworking, commuting. We've been tracking pretty closely shift in behaviors. We are seeing polling that would certainly suggest that some version of this will likely continue, as a lot of people have expressed interest in at least part-time teleworking for those that are experiencing it now. But it still remains to be seen of how much of a shift we will see, 3 to 4 to 10 years from now. And so it's something that we are currently wrestling with and paying attention to. We are going to be specifically wrestling with it in greater detail with 2 major plan updates that are just kicking off right now. So we're updating the statewide multimodal transportation plan and the 20-year highway investment plan. We anticipate having drafts of those in early 2022, early to mid 2022. So we'll be engaging in this discussion about how should our plans adjust to some of this new direction over the next year. And we'll be wrestling with that. And there will still be a lot of unknowns, I think, as we head into next year, but this will be a hot topic for us and an opportunity for all of you to weigh in on whether our investment direction should really shift and whether our measures and strategies should evolve in light of how the world is shifting around us. So that was really quick, fast overview. For some of you, it may have been just review, and you can find out a lot more information at mndot.gov/project selection, and we'd be happy to hear what questions you have.
Okay, thank you. That was really great. I'm so happy about all the information on the website. I think that will be super helpful. And so, yeah, we really appreciate all this, and we'd love to get a copy of your presentation because I know folks will want to reference this. Again, we will all, I think, be engaged in the conversation about the impacts of changes in how people get around, how freight is moved, and what the transportation system needs to look like in the future. So thank you so much. I don't see any questions in the chat box. Again, just a reminder to everybody, if you do have questions during a presentation, to please put them in the chat box and we'll make sure that they get asked. Okay, thank you. So next up, we're going to shift a little bit and talk about major transit projects and what's happening around the construction of those. And so we're very pleased to have with us Nick Thompson, who works for the Metropolitan Council and is the Director of Transportation Services, and he is going to talk to us about those projects.
Good afternoon. Can you hear me okay? And do you see my screen?
Yes, we can hear you. And yes, we see your slides.
All right. So thank you. So I'm Nick Thompson. I'm the Director of Transportation Services at the Council, responsible for both our long-range transportation planning and some of our contracted transit services. Similar to last year, I thought I'd give let's see if I can get this to work. Just a little look at the metro region before I dive into transit. Our outlook, like you've heard many times, we have an aging highway infrastructure. Our transit system is really still in its development phase, and that's over the next decade, we're really building out that transitway network. Our travel patterns are changing. We are still anticipating, I think, 400,000 to 500,000 more people in the next 20 years in the 7-county area. Like Philip mentioned and others have mentioned, we are trying to understand how the travel patterns will change with COVID, not just this year, but in the long term, and how that should affect investments in the region, particularly around congestion. That has been one of the big changes this year, and how will that hold out in the long term on our highway network? Trying to think about technology and then the quality of our transportation system and how it changes, advances equity both in the region and the state, and sustainability and prosperity. If you look at our TIP, which is about to be adopted and amended into MnDOT STIP over the next 4 years, we have $5.1 billion of transportation investment planned. This would be any of the projects that have federal funding in them or MnDOT's projects in the region. So some of the local projects are within this number if they have federal funding. It's spread across our 3 major modes. Both highway and transit are the ones, all of these modes are facing different changes in terms of COVID impacts in the future. Bike and ped infrastructure is probably the one mode this year that's seen a dramatic increase in usage and demand for thinking about building out that network that we have in our region. In terms of the major projects that are under construction or planned for the highway side, the first one's a great example. It's open to traffic now. I think Jody had mentioned earlier about how the counties are taking on responsibility for trunk highways. This is Scott County leading this project of intersection of 2 trunk highways that had long been identified as a major need, but just had never had the funding or prioritization. So it's good that project is nearing completion, along with our Minnesota River Bridge, 35W 94, which I'll talk a little bit about, is also a major transit investment for our region. MnPass continues to be built in these corridors along 35W and is planned for several corridors going into the future. If you happen to be a commuter through the northwest part of the metro over the next several years, you'll be experiencing a lot of construction as both Highway 10 and 94 and 169 start to get major expansion investments made in those regions. So great projects, some funded, but these are all projects that advance that growing area of the metro network. And then our needs of multiple projects that receive significant funding but are not fully funded, I would say, to build what is needed for the transportation need. 252-94, converting a signalized principal arterial over to both a freeway and a MnPass lane. This is one of our heaviest transit corridors for commuter network transit in the region also. This was funded through the Corridors of Commerce project and has a lot of local and other federal funding in it. Same with the second project there that was 494 that received Corridors of Commerce project for both expansion of the freeway, but also the long identified need and priority of the 35W and 494 interchange. Both of those projects are great examples of clear needs for transportation investments, receiving significant funding through state funding and some federal funding, but really to complete the project, there's probably multiple phases to those projects over time based on the limited funding that we have to do those projects. From a major transit investment standpoint, we are in the build and engineering and design phase of many projects, and I'll highlight a few of those. We're building light rail networks. Bus rapid transit is our major investment category that has been the last few years and has got a recent boost from the state bonding. Then we have a few major facilities that are either just completing or in major construction to support this transit network. This is our metro system. This is the vision that is being built out in our region. As you think about the highway network was really in a lot of ways built in the 60s and 70s for a regional highway network. We're now building that transit network, and in some sense, I don't have a slide for it, but we're building a regional bicycle network too throughout this region. This is the network of the highly reliable, frequent services serving throughout the region and allows you to be connected to that network, to travel throughout the region to jobs or entertainment or shopping or school. A lot of our trips are school-based. Some of these lines, the first one being open was the Hiawatha line or the blue line from Mall of America and the airport up to downtown Minneapolis. And the green line following after that, but now we're building arterial bus rapid transit, highway bus rapid transit, along with the light rail development. These, like highway projects, these transit projects take a long time to go from idea to local support to opening to the public. So as I talk about these are kind of the three phases to think about. Project development, which is usually locally led and before the council takes over. Completing environmental phases, selecting what the route is, what the mode is, where the stations in general are. Then we move into what is typically a 2 to 3 year engineering phase to design these projects. They are design build at this point. They are all kind of planned as design build, though there's opportunities for other delivery methods. And then that last phase is when we get into this construction mode. If they are in the major category for federal funding, they actually start off in construction before they receive their final federal funding, which is the full funding grant agreement. Green Line or Southwest LRT under construction now. Probably have a couple years left of what is the largest transportation project ever built in Minnesota. It's a completely new line, LRT line that extends existing green line from downtown Minneapolis out to Eden Prairie. The way you think about where we're at in the phase of the metro network extension right now is we're really building out the lines to the suburban, connecting the suburban market with the core cities. This should open in 2023 or early 2024. It is now a fully funded project. We're into year 2 of this construction. We just received over $900 million in federal funding for this project in September. And so this full project budget is funded. It is probably, in some sense, it's an engineering marvel what is going on in terms of the amount of construction to build this. There's over 40 bridges, multiple tunnels. The technology and investment that is going into this is incredible. But it's also economic development. There is, I think, 3 times as much planned or existing development that is occurring around the stations as is in the construction. So there's massive amount of development occurring around each of these stations as we speak. A lot of the development is opening even before the line is built. And so that is both a huge construction project, both for the transportation, but for the economies of the region on that project. Orange Line is also under construction now. This is the first of the ones I'll talk about that is about to open. It should open at the end of next year or early 2022. This is in part built in stages. From 46th Street to downtown was built through MnDOT's 35W94 project. As the 35W was being modernized and widened and min-pass lanes added, we're also adding the transit components that connect to downtown and various transitway networks. Includes a tunnel under 494 and stations all the way out to Burnsville, and realignment of transit services in the network to connect to these stations. So that is soon to be open project. Gold Line is a project that has transitioned from Washington and Ramsey County to the council in the past year. We are about to enter the engineering phase of that project to complete engineering. This is our region's first dedicated guideway bus rapid transit, which means at least 70% of this the route is on dedicated route for the buses. So a roadway, and essentially a bus roadway that's being built along the alignment that you see here, connecting Woodbury, Maplewood, Oakdale, St. Paul, and then connecting to the downtown Green Line and other stations. So a major construction project about to enter engineering phase. Blue Line extension, the light rail line that would be extending the Hiawatha Blue Line that started from the Mall of America to downtown up to the northwestern suburbs of the metro. Still planned as a light rail. It took a little bit of deviation this year where 8 miles of this line were anticipated to be in the railroad right-of-way that runs along this route, and could not reach any agreement with the railroad, and so we're taking a pivot from that route and finding a new alignment for that outside of the railroad right-of-way. So that will have some TBD in terms of when that will open and what the estimated budget. But the intent, as the local Hennepin County has stated, is the goal is to still continue to have a light rail network in this area. We just need to take a step back and find a new alignment for a portion of that line as it gets ready to build. Rush Line BRT is like the Gold Line. This is a partially dedicated bus rapid transit line connecting the northeast suburbs all the way up to Maplewood, White Bear Lake, ending in downtown White Bear Lake, and using abandoned railroad right away that was procured by Ramsey County Regional Rail and preserved for development just like this, leading up to the northeast. That one is about to enter project development phase, and it would start construction in roughly 2024, with 2 to 3 years later having service beginning for the public. The most recent project to enter a new phase is the Riverview Modern Streetcar. This goes from downtown St. Paul to joins the Hiawatha Blue Line near Fort Snelling, and then continues on using to the airport and ending at the Mall of America. It's very similar to light rail, but it's a two-car system that often runs in mixed traffic along Highway 5 West 7th for portions of that. It will have some dedicated right away also. This is early in the stages, so we're still over a decade away from this opening to traffic, but entering major project development phase now in the past month with consulting contracts recently been awarded. Ramsey County is the lead agency for the next several years on this project, and it'll eventually transition to the Met Council as we enter engineering, construction, and operations phase. So if you look at this over the next decade, the stars indicate the year that we're anticipating these lines will open. I'll talk a little bit about the BRT, but this is part of that network that has really started maybe 2008 with the Blue Line. It's taking several decades to build out this network, in part because of how funding flows for both federal and local shares and state shares progress, but also just the fact that these are mega projects. Many of these are just mega projects from a development standpoint that affect many communities. And so getting the right project design and local support and engineering, these are very complicated projects to design and build. It takes many years to get that project right. So this is the schedule moving forward. And I should highlight too that these are the type of systems that, people ask about the impacts of COVID on travel. We are seeing very different impacts on transit depending on the type of system. Our commuter and express market is basically in our region has really disappeared. Express routes and even the North Star train, our ridership is down 95%. But on some of our rail and especially our BRT, our existing arterial BRT are running at 100% or more than what they were pre-COVID. And so we're seeing different demands based on the mode and the location and what their mode was primarily used for. And so it's something we'll have to keep considering as these projects develop and we see the impacts of travel over time. And lastly, these major systems are built, need support systems that are built also. Our bus garage that will support our arterial bus rapid transit network. We were at capacity for bus garage. For over 10 years, we were seeking state bonding for this. We finally found the funding sources necessary to build that. So that project is underway in Minneapolis. We're also prioritizing modernization of our transit centers. The picture in the lower left is the new Mall of America station that's opened in the last year. That's one of the largest transit hubs in the network. We are in the process of moving towards an electrification of the fleet, slowly starting towards that. That is more than just building a bus or carrying electric buses. That's a whole system of electrification needed to maintain an electric fleet. And of course, like on highways, preserving our existing system remains one of our key priorities. I think that's all the slides I have. I'm happy to take any questions you have.
Okay, thank you. That was great. That is a lot of really good information. I think we have, if I can get this open, a few questions. Let me see here. So what is the status and outlook for the North Star extension to St. Cloud?
Well, MnDOT led the recent study of the North Star extension, and so I wasn't enough involved in that to answer. I don't know if somebody from MnDOT could answer that.
Okay.
This is Philip Schaffner. I'm just posting a link to that study in the chat. It was a feasibility study. I don't know if we've received anything subsequent to that yet on any kind of funding or moving forward with it, though.
That study was completed this year, I believe. So
Yeah, okay, and we can get a link to that up too. So what about MnPass lanes and the future of that concept? Do you see anything changing there?
Well, we are in the next few weeks adopting our new transportation policy plan for the region, and we continue to show MnPass as one of the priority investments for corridors that have congestion. The question will be what happens with congestion. We're seeing much less congestion on the system than we did earlier in the year. If we can, that's thing. I think one of the things we really need to watch once we are over the hump of COVID and people have the ability to go back to their workplace at large scale, and whether they do or not, or really shift their patterns. So it's really a question more about congestion. What's going to happen with congestion, and do our investments for that need to change? There's several projects of MnPass still in the works. In the long term, because we're growing, we know travel is coming back. There's just going to be a lot more trips on our system, period, even if there's a larger amount that are teleworking on a given day. So I guess that would be our council's position at this point. Something we need to monitor.
Yeah, I have read that in some other countries that with people going back to work, there was even more congestion because of people who used to use transit deciding not to use transit. And so that'll be another dynamic to watch. Can you talk about the type of fuel that the streetcars will use?
Yes, these will have they'll be just like light rail. They'll be electric. They actually can integrate with the light rail network, so they'll share track on portions of that system.
Okay. I wanted to ask too, we didn't really get into this much, but the operating funds, with the CARES Act money, if there isn't more federal funding, when do you anticipate that kind of running out? And what are you looking at for a shortfall, I guess, for transit that you might be looking for additional funding in the next biennium?
Sure. The CARES our region received over $220 million for transit from the Federal CARES Act that was shared among all the providers, Metro Transit, suburban providers. The U of M received some of that. For the council and Metro Transit, that was a lifesaver in terms of our operations. That gets us through both this year and next year, being able to afford, have sufficient funding for our operations. We also have reduced our service quite a bit, and so those combination of things have allowed us to have a budget that is balanced. It's the year after that, we're under calendar year, but state fiscal year, not this fiscal year, but the one after it is where we start to see fiscal cliff for transit if things do not change. I don't have the numbers offhand, but it's significant. We had an issue prior to CARES, prior to COVID, and COVID has had a big impact on our funding sources. Motor vehicle sales tax has been hit some this year. Seems a little better than we thought it would be when we looked in the spring, but our fare revenue is down significantly, and some of our services we know are going to come back, especially our Metro Mobility, which is funded by the State General Fund. That is in a fiscal deficit also, and is a required service. And so there's a significant need that is coming, and that we'll be able to share, I think, in the coming months as we are developing the budget for the governor.
Okay, great. Okay, does anybody have any other questions? Anybody in the room? Nope. Okay, well, thank you so much for that presentation.
Thank you.
Okay, so we are amazingly ahead of schedule, which is fine. I just really want to thank everybody so much for joining us today and being part of our 127th annual meeting. We hope that you found this information really useful and helpful, and that you'll continue to work with us. As you can see, there will be a lot of challenges going forward. And while we have some good news, we have a lot of projects in the works. You can also tell that there's a lot of uncertainty around the future, both in terms of what projects are going to be needed and where the funding will be coming from. So we really need your input and we really need your participation going forward. So again, I want to thank everybody for being part of this. Please stay tuned for additional webinars that we'll be hosting and information that we'll be providing as we get closer to the legislative session. So have a great day, everybody, and take care if you're driving. Hopefully there's not a lot of snow out there, but thank you so much and have a great day.